What's up, everybody? Welcome to the life cycle of a trade, the series where we break down the thought process behind trade entry, trade management, and closing order. In this video, we're going to cover a zebra. All right, so we've all seen this move in gold futures. Gold is down $19 right now, but it has had a meteoric rise over the last couple months here. Over the last 2 days, it's had about a 5 to 7% upside move. A huge move there. Volatility itself, 67 at IV rank, very, very high. Silver, though, has not really seen as much of a move. If we look at silver futures, they did have a nice upside move yesterday, giving a lot of it back, but it is nowhere near highs or exceeding highs like gold is. And so I think it's interesting to play into this move in silver with a new type of trade that we haven't done in this account. And this is a smaller size, $5,000 to $10,000 account. This trade is a small way to get long stock or short stock if you wanted to. So when we look at silver, SLV is the silver the ETF for silver, for spot silver, $29 and change here. When you buy 100 shares, it uses about $1,400 in buying power. So it's a relatively capital intensive trade. Silver doesn't move all that much. It does have a higher volatility than gold, but still one of the precious metals. So it doesn't move a ton here. But one of the ways that you can get synthetically long stock is via a zebra trade, which is a 100 delta option trade. So you get 100 shares exposure to the stock. When we look at like the analysis mode for just the stock position, you could see this kind of just binary, up is good, down is bad. When we do a zebra trade, and you can do this in any expiration as you go further out in time in terms of the duration on the trade, it's going to use a lot more capital and might not give you that leverage that you want. If you're in an IRA or a cash account, it'll certainly be a cost-effective way to be long stocks here, just because with a margin account, you get about 50% leverage on the notional shares. You can see here about $30. This is about half of that if I were to buy shares at a notional cash secured value. So when we're looking at a zebra, we typically go to somewhere about a 70 to 80 delta for the long options. We're going to buy 2 calls there. That's going to be about 140 to 150 long deltas. And we're going to sell an at-the-money call against it somewhere between a 40 and 50 delta, which is going to net us out to about 100 long deltas here. I'm going to go out to July just to give myself a little bit of extra duration here. And again, this is a 100 delta position, so it doesn't really, the cost is really just the difference between the expirations and the duration that you have the 100 shares of stock. So I'm going to go to this 27 strike. You could certainly go to the 25 strike, but it really doesn't matter here for this example. So we're going to go, this is going to net us out at about 150 some odd deltas here. We're going to sell, let's call it the 31 here, 40 delta. You can make this if you wanted to really flatten this out, and we're going to sell one of these. If you really wanted to flatten this out, you go to the 30. I'm going to give myself a little bit of extra delta exposure to the upside here and go to this 31 strike and sell one of those. You can see the extrinsic value is going to be a net positive here, or basically flat. You can see I have about 0 extrinsic value here. Synthetically long stock, which has no extrinsic value. When we look at the curve mode, you can see your risk profile is very, very similar to the upside as you would see with a long stock position. Up is obviously good here. To the downside, you actually have an embedded long put. So you are basically long the stock and long the 27 strike put for free synthetically, because your extrinsic value here is basically 0. So that means you're getting this free cap to the downside. Not that I think silver is going to go to 0, but if you're using this in any other stock, you do have that potential risk. You have this embedded put where your risk stops out at 27. You can't lose any more below 27 here than whatever your debit is, which is $5.61. You can see the break even is going to be right at the ETF or stock price here, which is about 30, and I've got that 100 and change long delta. So I think this is an interesting play for a catch-up trade in silver relative to gold. So I'm going to ship this off. $561 debit on this trade to be synthetically long 100 shares of the silver ETF. Let's get it here. We're going to try and get filled here. Let's go a little bit above the mid and see if we get filled. No fill there. We cancel replace from here. Really going to make me work for this one. All right, we went in at 570, got filled at 568 here. We are long silver shares synthetically via the Zebra trade. So again, this is a small account way to be long stock, an interesting way to do that in a $5,000 to $10,000 account. Silver up to 34.62 here, up almost 5%. This trade has been a great trade. You've got a ton of time left until expiration. So if you wanted to hold this trade and keep this stock rental for another 46 days, you certainly could. Some other flexibilities that you are allotted here is that, you are synthetically long stock, so you have an extra call that you could sell. So if you really wanted to, you could sell something like the 32 strike call here, and that won't use any additional buying power. When we click the call here, you can see it actually gives you buying power relief because you're selling premium here. You could sell a 33 strike. Any call that is above the Zebra, you could sell without using any additional capital, and that position would turn it into more of a covered call type risk profile you could see here with a cap in your profit potential instead of having that unlimited profit potential like you would with just a stock position. For me, it's just been a perfect trade. It happened, it took about 30 days, a little bit less than 30 days to get to this point. You're having a nice move today. No point in trying to, mangle this trade and make it into something it's not. It was a purely directional shot. We got the direction right. It's time to go. It's a nice profit here. We're going to try and get filled and close this one out. Let's start above the mid price, and we'll see if we can get filled on that, and we'll just work our way down here. So this is a really capital efficient way to be long stock in a margin account versus just buying the stock. If you're in a non-marginable account like a cash or an IRA account, this is a really, really good way to get a little bit of leverage on your cash to be long stock. So we got filled at 764. It's a $196 profit, a nice trade for the Johnny Trader portfolio, a good, 20, 30, 40% return on capital here just on that trade alone. So great job out of everybody that followed that one along.